All right, I'm going to kick us off and kind of where we're at in the economy and then bring up Dan to go into some of the drivers, a little bit of a deep dive. You guys are familiar with our chart. We love to see green, we don't like to see red. It's a lot of yellow. So it means that it's kind of neutral. We don't have a whole lot of clear direction. You know, one week we're at war, the next week we're not. One week gas prices are coming down, the next week they're going up, right? A lot of uncertainty, and that's why we're going to focus in on that a little bit today. I mean, there is a couple of positives, and one of the reasons the market is up is because corporate profit growth, very strong. You know, credit demand totally available, but a lot of other things just not clear direction here in the middle of the year, and we're going to talk a little bit more about this. When we look at where the markets are at the end of June, the S&P is doing pretty well, right? The pure S&P is up 10.2%. Now, if you've watched the last couple of weeks, we've had a little bit of a drop off. That's the only problem is trying to present something you did last week. It might not apply to this week, but here's where we were at the end of the month. It's off only a couple of points, and actually, we've been seeing 2 to 4% variation, right? Volatility in the market, so that's not unusual. But look at that 3-year number. We've had a pretty good run here, right, in the equity market. Look at even international emerging markets. They've improved and done a lot better. When we're talking about alternatives, different bonds and things like that, bonds fell off a little bit. They were doing really well, but we've kind of pulled back a little bit on bonds. One of the reasons, and we're going to talk about it, is where's interest rates going, right? They may actually be going up. So we'll be talking about that. Here's another one though. Hopefully not too many people bought gold last year because it's not doing that well. If you did, and we believe in it, I mean, it should be part of a small part of the portfolio, but basically it's not having a good year. But it's had a good run for the last 3 years. When we come to the right side, and this is where I want you guys to really understand when you're investing that we're not just trying to chase the high flyers, because when you look at what's actually happened, and it started at the end of last year, moving into this year, this gray line is the S&P 500, which the Mag 7, the largest tech companies in the US, are part of that. But look at how the Mag 7 has done this year. Very volatile and actually going down. Now, and this wasn't the case for the last 2 or 3 years that generated these numbers, the S&P without the Mag 7 in it actually is leading the pack. So the growth is broadening in the markets. And one good thing is that's what we do with your portfolios is we're well diversified in the portfolio. So we're not just trying to rely on a few things. We're starting to see that growth in the rest of the industries. So I just kind of wanted to set that as the preface before we move on. So let's welcome Dan.
All right, so policies, policy and geopolitical issues that are out there or events have really been driving the news a lot, and it sometimes drives the market. But generally speaking, with what's going on today and what has gone on last year, it's typically going to be a gyration. And I'll talk a little bit more about that in a couple slides. But thinking about tariffs, you go back to the beginning of last year, really the first quarter, when they started talking about tariffs, and you could look out and say, well, you listen to President Trump when it comes to tariffs, it was going to be anywhere between 2% to 200% China, right? And there was an awful lot of hubbub, a lot of talk about how the tariffs were actually going to drive the market down. It was going to create out of control inflation, and we were going to have a major problem. It did create a lot of tension out there. There's no doubt about that. But if you look at the chart on the left, once Liberation Day came about, which whatever that term really means, you had it drop a bit after a little while, and then it kept stabilizing lower and lower and lower. So we went from this range of 2 to 200% in tariffs, and we pretty much leveled off at around 10%. And that's kind of on an average across the boards. And the issue with the tariffs is when they first came out, there was a gyration in the market at that point, right? And we'll look at that in a little bit. But after a while, the market kind of continued on doing what it was going to do. The other issue, which has been going on since the beginning of the year, is the Iran conflict. The reality is we've got a problem over there still. You know, we bombed the heck out of them, good, bad, or ugly. We got rid of what we thought were almost all of their arsenal, but what we have found is that they don't need a whole lot to slow things down. They need enough to hit a barge or something, and that kind of halts things. And what has happened, the gray, if you look at this chart, this gray mountain chart, this was the flow of oil through the straits. And after the conflict, this is how low the flow went. So it dropped dramatically. In the beginning, if you look at this aqua line, we saw oil prices shoot up, but they have gradually came back down to just about normal at this point. You know, there are other sources of oil, and the question is, when it comes to the US, why are the gas prices so high if we're not affected by this and we're energy independent? The reality is yes, we are energy independent, but we don't have the refineries to refine all the different type oils that we have to work with to get the products that we need. You know, Texas is great for bringing out oil for gasoline in the cars, but it's not so good for plastics and other products. We still have to get those from abroad because we just don't have the refineries at this point. But the prices have come down and normalized a little bit here. And unless something really sparks up in the Middle East, we should see not normal prices, but below $4 prices by the end of the year. Now, looking at the two events that took place, one was the tariffs, the other one, the crisis in Iran. You can see the first quarter, we had a big dip in the market, but both times after we got through that gyration, what did the market do? It went back to the course it was already on. And this is something that is kind of vital to understand when it comes to shocks in the market that are not based on any major fundamentals that are collapsing. If you think about 2008, there was a shock to the market, and fundamentally, we had a problem in the banking system, and that's what drove the market down. I would also point to, 2000 in the dot-com, the market was coming down, and then on September 11th, what happened? Well, we had the towers attacked, right? The market was coming down. There was a gyration down in the market. Then it came right back up and followed that trend line down. If you look at any stock charts, you'll see it very clearly what happened there. So my point there is if you've got a healthy economy, a healthy stock market, you will have those gyrations, which I look at as opportunities, but it's going to follow where you were going in the first place. If the economy is going down, it's going in the tank, and the markets are going down, and there's a event at that point, you'll see that gyration, but it'll keep following that trend. And right now we're in pretty good shape, so that's not really an issue. Okay, and one of the reasons it's not really an issue is AI and the spending that is going on with AI, which is just absolutely phenomenal. Matter of fact, it's absolutely mind-boggling. If you look at the chart on the left, it shows you what they're projecting 26 through 2031, and ultimately the spending that's going on is expected to top $7.5 trillion. I mean, give me a little piece of that. That's all I want. I mean, that's just a ton of money. And the fact is big companies are pouring this money in for a reason. You look at the spending that's going on right now compared to where we were before, and the AI adoption that's going on right now there's a reason for this. They believe there's going to be a big payday on this, a big payday. And there are a lot of sectors right now where you're already starting to see that payoff coming out. On this chart, when you look at the growth of the adoption, it started coming in 2016. We had COVID hit, everybody got locked up, all the programmers were stuck in rooms, they couldn't do anything anyway, so what did they do? They created AI, or they enhanced AI. And you saw a big jump after that point in entrepreneurship of building this stuff out to actually work with multiple markets. On this side here, and this is really interesting when you look at the left side of this chart, you've got two lines going on here. One is kind of this nice line that's going up, that's the aqua one, and then you got another one that's going up, but it's just not going up as much. And what does that represent? It represents companies that are very high in AI spending, that's the aqua line, and then companies that are not. And that's not how much they're spending. That's the fact that these companies' revenues are growing 5 times more for companies that are spending the money than companies that aren't. That's a big deal. So what you will find happen over, gosh, I don't know, the next 5 years, is you'll see more and more companies adopt like crazy, and those that don't will probably be bought up by other companies, or they'll just fail. And that has been the prediction over the last 4 or 5 years when it comes to AI. If you do not adopt and adapt, you will die. And it's really kind of playing out there vividly. And then you look at the money that's being spent. The hyperscalers, the Amazons and the Microsofts and such, are just pouring a lot of money into AI. And right now, they're actually getting a bunch of bonds to do it. They're actually going out, having the bonds produced, selling the bonds, getting the money in to be able to build out their AI infrastructure. Is that unusual? No. In any kind of technological change, when there's a big change, there's always people with a lot of foresight and the money that go out after it, and they want to be one of the first ones to be to the market share with it. And that's where the profit is. It's always the first ones that go out. Now, what is unusual is just the magnitude that is it's going through, and they're purchasing these bonds. And there's a lot of people out there that are purchasing them because they have faith in the direction it's going, financially speaking. This chart here, we've got basically 7 phases of the AI value chain. You got the beginning over there where energy is really put into creating, and then all the way to 6 and 7 where you're actually able to sell the product and reap the rewards of what you build. Now, the problem that we're running in here is in that center around 2, 3, and 4, and that is the fact that we do not have, again, the infrastructure to build to the capacity that we want to grow. And that's kind of creating a bottleneck at this point. Which now brings me to the consumer and how resilient the consumer has been. It's interesting when you think about the consumer. The consumer is about 70% of the GDP, right? And if the consumer pulls back, what happens with the GDP? It goes down. It really can tank an economy. But one of the things that tends to happen for people to pull back is there's typically a lot of jobs lost. But the reality is that's not happening right now. Now, are there pockets of companies, because we see it in the news, this company laid off 1,000 people. But the thing is we're actually adding jobs, especially compared to last year. In 2025, we added an average of 10,000 jobs a month. Okay, not a whole lot. Well, we're 11 times that this year so far. So it's not like we're losing a lot of jobs, and that's going to create a problem down the road here. We're actually adding to it, which is really what's keeping the market going. If people have a job, if they know they've got money coming in, they spent. When you look at the resilience on this slide, you've got two different slides. The first one over here, the higher income earner, you look at 23, 24, 25, and 26. The spending has been relatively consistent and actually has been going up all the way into May of 2026. The issue is we're starting to see kind of a K economy emerge right now, where the people with the higher income, the people with the means are still spending, but the people that do not have the means, the lower and middle, are starting to cut back a little bit. Now, thankfully, there's enough money being spent on the top that's still driving things, but this is something that if the trend continues, could be a little bit of an issue. Now, the reality is if we can get oil prices down, that controls the price of an awful lot of stuff. We get that price back down again, people are going to feel a little bit more comfortable, because what's happening is inflation is actually taking away faster than the wages are growing at this point. And if you think back over the last 5 years, it's kind of been weird, but in some sections of the economy, you were literally seeing the income outperforming inflation. And as you know, during COVID, inflation got pretty high at that point. There was a lot of pressure to push the rates up for hourly wages. Right now, that pressure isn't there to offset the additional inflation. That brings us to earnings. What drives the market? What makes a stock go up? It's earnings, right? If your earnings are good, it helps push a stock up. If your earnings are bad, what's going to happen to the stock? It's going to drop. And the interesting thing on earnings is this. Over the last 5 years, most of the market growth has been where? It's been US large cap stocks predominantly, right? And just recently, over the last year and a half, we're starting to get into mid cap and small cap stocks that are performing. But it's not just the US. It's now a tale of 3 different regions. And this doesn't happen all the time. There's usually ebbs and flows between each one of these regions, as you can kind of tell on this slide. The gray line here is the S&P 500. The blue line here is emerging markets, and then the dark blue is international developed. And you can see up until 2020, there's been a lot of gyration on these two, but not so much on the S&P 500. That's why most of the focus has been in the US when it comes to the stock market, and that's where most of the growth has been. But over the last year here, you're seeing all 3 of these kick in. Now, that's why you're probably seeing in your portfolios more international developed, a higher percentage, more emerging markets. We've always had it in there, but it's at a larger scale right now, and we've also scaled back on US, although we picked up on small cap and mid cap. So there's a little bit more diversification in the overall portfolios, but there's a reason for it, because these 2 markets here are really kind of killing it right now. So that's a very good thing. Now, I was talking about earnings, and when you think about the returns of stocks, doesn't matter whether it's the stock market as a whole or an individual stock, what really should drive the growth of a stock should be the earnings. If you look at this chart here and you go back to the dot-com bubble, the profits weren't there, but yet the price of the stocks skyrocketed at that point. And at some point, the valuations and the stock price got so far out of whack that people started pulling money off the table, which caused a frenzy, and that bubble popped. So there was a huge gap between the profits and where the price was. If you fast forward to today, we don't have that issue. earnings and profits are driving the stock price up. So are the prices going high? Absolutely they are. But the earnings are supporting it. There is no bubble there. This was the bubble. There's not a whole lot of gap here. So there is no reason to believe at this point that we are going to have some kind of major correction in the market. Even though over the last year, you probably have seen the Mag 7 kind of dip a bit, right? You know, they dropped about 20, 25%. Well, it was people taking money off the table, but the companies were still solid. And they'll work their way back up again, especially once a lot of this AI starts really hitting the fan. It's going to make a big difference.
What I want to do, I'm going to bring you back out of the weeds and kind of recap all on one slide, because I really want you to understand, if you can think back to last year at this time, in this meeting for the mid-year, we were talking about a couple things had to happen last year for the stock market to do well. And we called it the pass, and that's why this is saying from pass to pace. There's been some changes. We needed the geopolitical and policy in Washington to line up. We needed the AI spending to continue. The monetary stimulus. Do you know what we're referring to there? The one big, beautiful bill got passed. Lowered taxes. Highest refunds on tax returns took place this year. With that happening and that money becoming available to corporations and individuals, that kind of gave us the boost to continue into this year doing very, very well, even though the economy's been slowing. Remember, I showed you it's yellow. We don't have any real strong direction anywhere in our leading economic indicators, but that was a big deal, okay? And then the fiscal stimulus, it says fading. We were saying, and interest rates will probably be coming down next year. That has shifted. So that's why we're going from pass to pace. Pace is the change at the end here. Consumer resilience has to continue even though the economy is slowing. Job growth is slowing. Wages are slowing. They're not bad, but they're slowing. So we still need the consumer because it's a big part of the economy. And the focus now is more on earnings growth, okay, than the federal government coming in and easing regulation, easing taxes. So since we're kind of in this yellow, neutral, what's going to happen? Are we going to continue to have a bull market? Or are we going to have a bear market coming? And here's the case for either side. When you look at the bull market case, what could go right? Oil prices fall, which will cool inflation. If inflation cools, the Fed can ease. AI supercharging productivity. We believe this is going to happen. We believe it's one of the reasons the broader market starting to participate in growth and outpacing the tech companies. And profit growth has to stay strong. Bear case, interest rates start to go higher and put pressure on the stock market. If corporations have to increase interest rates on their borrowing, that's going to reduce the bottom line. Okay, that's going to hurt earnings and profitability. What if the consumer continues to weaken? Dan talked about that K recovery, right? The top 20% of the wage earners are actually producing 80% of the spending. Okay, so we need the whole market to be participating. And the third is AI spending slows. Okay, now think of AI spending, and I know Dan kind of touched on it, but I think of it kind of like building a house. Who do you pay at the beginning when you're building a house? The builder. That's the tech companies. They're the developers. They're the one building this infrastructure. But who gets paid after you move in? Right? It's all the other companies. The electric company, right? The gas company. You're buying appliances. You're fixing the yard up and maintaining the yard. All those companies now start to benefit from the house you just built and bought. Okay, so that's kind of what's going on in AI. The developers are developing and they're spending a lot of money to do it, but you see that their growth could be slowing because it actually has to get implemented and be used in the larger business economy. So let's get out of the weeds. Let's talk a little bit about noise versus signals. Anybody recognize this guy? He's been talking a lot about this lately, okay? And when he does, he primarily is talking about two gentlemen, right? The creator of Apple and the creator of Tesla. He uses those guys as examples of, hey, these guys know how to take the noise out and focus on truly, as he says, the rare art of tuning into what truly matters. And I think one of the issues we have today is there's so much information. There's so much social media out there. You can start reading an article and think, oh, I'm getting a grasp of this. And you scroll to the next one and it's a totally different opinion. And not only another opinion, there's 1,000 opinions. What's the truth out there? It's harder and harder to find. What do we focus in on? What does history tell us? We've had people ask recently, hey, the market's kind of been hitting some highs. Maybe this isn't a good time to invest. This would say maybe not. The chance of the market going up and reaching a new high the very next day is 55%. This is when you're in a bull market. We've been in one since 2022. They can tend to run 3 to 7 years. We don't think we're done. All right. Within the next week, 81%. Within the next month, 93%. Within the next year. We're long-term investors. I have some cash. Should I invest it? Yeah, let's invest it in the broader market. That's going to start participating in this growth and maybe get some efficiencies through AI. That's a pretty good percentage in 1 year. That's a good track record. Yeah, maybe if you've got that money to invest and you can leave it in the market a while, let's do it. Let's get you invested. This is the year to date of 2 ETFs that represent S&P 500 capital weight, which means it's weighted by how large of a company. Larger companies weigh more into the whole performance versus equal weight. Right now, equal weighted S&P 500 has outperformed the capital weighted. And that's what we talked about at the beginning, that the MAG 7 actually has been a drag on market performance if you're in that type of portfolio. Most of us have components of this. Most of us are diversified. We're not just sitting on an index. And we're starting to see that productivity and earnings improvements translate into your portfolio for all the companies. So we're seeing good signs here for diversification in the future. Okay? A tailwind. Those were kind of positives. A tailwind. Back in February, if you'd have asked the analysts what's going to happen to interest rates this year, 96% said they're going down. Today, 84% are saying they're probably going up. That's a huge shift. But this is a signal, okay? This part isn't noise, right? 16% say no change. We're focused in on this. Now, does that mean another 2022 is coming? Does anybody remember what happened to the bond market in 2022? It went down with the stock market. So if you had a stock and bond portfolio, it's like, wait a minute, bonds didn't do their job. That's right, they didn't. But that was kind of an anomaly. And I'm going to talk about why. Here's the bond rates at the end of 2021. If you're making nothing on a bond and the value of the bond goes down, you have nothing to counterbalance it. You're not getting any interest payments on that bond, right? Because they were at zero. And that's why 2022 was such a bad year. Since then, rates went up, new bonds are issued, we're buying those bonds. If we see an increase in bonds, look what they're actually worth today. Okay, if you got to hold them a little bit, they're still outpacing inflation. So it's a totally different scenario. So we're not as concerned about the talk of, hey, interest rates probably aren't going down because we have bonds paying very well. And we've been focused on the sweet spot. We've been avoiding long-term bonds. And you can see why, is because if you have to lock in under 5% for 30 years and rates go up and now they're issuing 6% 30-year bonds, you're not going to be able to sell yours. Okay, but if you're sitting on a 1 year and rates go up next year, yours is going to mature. You'll be able to buy a new one. at the higher rate. 2-year, okay, you're sitting on one for 1 year at the most. So we have taken the risk out of the portfolio by staying short term on the bond durations, okay? So yes, you have bonds, but realize here's where we've been buying. And we talked about that last year, going from cash into locking some of these shorter term bonds. Because many of us had cash in the portfolio that 2 years ago was paying almost 5%. Well, that's down to 3 and going down more. So it makes sense to use the shorter term bonds in your stock and bond portfolio. And this is one of my favorite slides because we all remember 2022. The dark blue represents the S&P 500 and the drawdowns when the market went down. The light blue represents the bond market. 2022 was the anomaly. Look at all the times in the past we were able to shift from stocks to bonds and ride out a down market. Okay? So with bond rates higher, we're in a better position to see that in the future, even if the rates go up. Make sense? Okay, so here's the numbers. When we look 30,000 foot level, is the economy growing? In 2025, GDP growth was 2.1%. Even with everything that's going on, our latest numbers show us still growing about the same rate. Okay, so the economy's growing. That means we're not seeing a recession signal. If we were seeing recession, this number would be going to 0 or negative. That's what recession means. The economy is receding, it's not growing. We're still seeing good growth. Last year was good growth. This year we're seeing good growth. This is really interesting. Look what's expected for corporate profits of the S&P 500. Last year, the average for the S&P 500 companies was their profits grew 12% over 2024. What are we seeing for this year? You want to know why the stock market's staying up with all the volatility and craziness that's going on? Companies are continuing to be profitable even in this market. CPI, the measure of inflation, yes, that is going up. This is all changed. This was one of the biggest changes. Originally, at the beginning of the year, this 2.7, we thought was going to be around 2.2 for this year to 2.5. Well, the war with Iran, shutting down the Strait of Hormuz, the cost of energy skyrocketed, took this back up. Now, is that able for us to manage? I think so. If you look at the 50-year historic inflation in the United States, it is around 3.5%. When you were working in your job and you went with your boss and he said, it's time for your review and you're going to get your annual increase, what was it? 3 to 4%. That was the cost of living increase, right? We all saw that. So that's pretty normal. So this is not out of whack, even though it's not where the Fed wants it or where we wanted it. It is a headwind to what's going on, but we don't think it's going to be too bad. And like Dan said, we believe by the end of the year, we are going to see the gas prices coming down. So another thing, if Fed funds rate is currently at 3.8, we expected it to get down around, we expected a couple Fed rate cuts this year at the beginning of the year. Not going to happen. Maybe we get one, very small percentage, but we don't see a whole lot of change. We believe they're going to hold more than try to increase rates. Hold a little longer instead of increase and have to decrease. 10-year Treasury note, again, this goes back to, hey, how much can I make if I just own a 10-year Treasury? We think that's going to go up to about 4.5%. Okay? Not a bad position to be in if you got a stock and bond portfolio and you can get 4.5 on the fixed side, especially if inflation stays below that number, right? 1% below means you're actually making real money, 1% of real growth, even on a bond. So I think there's a lot of good in the story still. Again, gotta put the noise aside, focus in on what we are seeing, what the underlying economy looks like, but if things change, Dan and I's job is to make the adjustments. We will get defensive if we see something change, but we're not seeing it right now.
I look at the stock markets and I look at how everything is progressing right now. And I've been saying this probably for the last 2 years, but I think we got another 2 years of bull market at least. So we still have some running room here before we have to make any adjustments. But like Rocky said, if something catastrophic happens, we'll make adjustments like we have in the past. So let's wrap it up a little bit here. Now, let's go back to actions. Remember these? These are our action items for 2026. Number one, keep you informed with events like this, the webinars and whatnot. Manage your investments according to your personal strategy. Everybody has a different strategy here. And we want to manage it to what your goals and needs are, not the guy down the street, not mine, but what you really need. And then stay on top of the changes in the market and the overall environment and make the prudent adjustments when necessary. And again, I don't see anything out there right now that's creating any kind of concerns from us. Now, on your side, you've got three things as well. Keep us in the loop on any kind of important changes that are going on in your life. This is extremely important because if there's a change, we may have to relook at the way we're working through taxes, estate planning, the market, whatever it happens to be. Tell us about any concerns if you have any concerns relative to the investments. The reality is everybody in this room went through an investment strategy meeting, which really, I don't think there's anybody in this room that has made a change based on market conditions, because you picked a target for a return, you picked your downside threshold, you haven't hit the downside threshold, and you're comfortable enough to keep moving forward. But if something happens in your life that you're just not comfortable anymore with it, we need to sit down again and revisit that to make sure you are comfortable with the returns and the potential downsides so you can stay the course. And then lastly, make sure your important legal and financial documents are up to date. And I believe everybody in this room will have at least an annual review where we kind of take our checklist out and we ask you multiple questions to make sure from an estate planning standpoint you're up to date, and from a wealth management standpoint you're up to date. But if something does change in your life and you notify us, we can then look to make whatever changes are necessary for you and keep you on track based on what your goals and your desires are. Okay? And that pretty much is it. Like always, you take care of your family and we'll take care of you, because we are absolutely ready for the rest of 2026 and beyond.